Credit analysis versus equity analysis, let's understand in this session. First, let me take you through credit analysis. Credit analysis is mainly done by banks or financial institutions to measure the repayment capacity of the borrower when they approach for a loan. The repayment capacity is targeted towards the capacity to pay interest, capacity to pay principal, because they are mainly giving credit and for that the return is interest and they have to get back the amount invested, that is principal. One uniqueness of loans and advances given by banks and financial institutions is that they are entitled only to the fixed benefit as per the terms of the contract. So the fixed benefit will be only in the form of interest. It means if the business is going to prosper, that is, let's say the borrower after taking the loan prospers, makes a lot of profit, but still that lender will get only the agreed interest. But on the flip side, if the business suffers, then this lender may at times have to bear the risk of default if the credit facility is not adequately secured with collateral securities. So lenders, when they do an analysis, when they do credit analysis, their focus will be more on risk and not the profitability. Of course, profits are important for servicing the principal and interest, but the lenders, when they do credit analysis, they will focus more on what will happen to the profit if sales drops, cost increases. So we can say credit analysis focuses more on downside risk rather than the upside potential. So that's the reason they give lot of weightage for liquidity analysis and solvency analysis, and only after this profitability analysis comes into picture. And their analysis is also dependent on the nature of credit. If it is going to be only a short-term credit, then they'll be focused more on current financial condition, cash flows, liquidity. And if they are considering long-term credit, then their analysis will be forward-looking. They'll be looking at the projections, future cash flows, and they evaluate the extended profitability, because term loans or long-term credits generally given for a longer period. So in the future, in that extended future, whether the profitability can be achieved, can be maintained, so that will be evaluated. So these things makes credit analysis unique, but equity analysis is slightly different. Equity analysis is done by or for the equity investors, and when they do this analysis, their focus is to assess both the downside risk as well as the upside potential. Maybe in this aspect the credit analysis differs, because credit analysis puts all the focus on downside risk, but equity owners, since they are also entitled to the profits which the business is going to make, they will look for upside potential as well. So they will be making two types of analysis. One is technical analysis, the other one is fundamental analysis. Technical analysis, most of us know, it's like charting, looking at the patterns, so we try to predict the future price movements. Whereas fundamental analysis focuses on arriving at the value of the company, basically arriving at the intrinsic value. So in this analysis, we will be analyzing and interpreting the key factors, say the economy, the industry, and the company. So the goal of fundamental analysis is to arrive at the intrinsic value, and the goal of any investor, equity investor, will be to buy the shares of a company when the intrinsic value is greater than the market value. That is, they know the real value of the company is so much, but in market it is at a lesser price. So they try to buy. It means they are trying to take advantage of it. Now the market value is less, but intrinsic value is more. And investors will sell when the intrinsic value is less than the market value. It means in the market it is priced at higher level, but its intrinsic value is actually lesser, so they try to come out of it by selling, and they will hold it if intrinsic value is approximate to market value. So for arriving at intrinsic value, we have to forecast earnings, cash flows, and these are possible only if we do in-depth analysis of the business prospects and financial statements. So both credit analysis and equity analysis differs, but what could be the connecting aspect is both makes use of financial statement analysis. Do you wish to learn more? I invite you to check our Diamond Live membership. This is a membership program which will give you access to 130 plus pre-recorded online courses related to banking, credit, finance, accounting, costing and so on. It will also give you access to 100 plus ebooks related to these domains. Gives you access to all the live classes which we are going to conduct. Will also give you unlimited access to all the future e-publications in the form of courses, ebooks, templates and so on. So this membership program is only for those who want to be a lifelong learner. So if you are a lifelong learner and if you want to make use of this opportunity, you just have to WhatsApp me Diamond to the number seen on the screen or simply comment DUM. I will share you the details.